Dude, so I was working out earlier today, just now.
It's too hot, man.
Dude, but the pounds on the bar aren't as heavy because of the UK inflation.
Oh, yeah, that's right.
Get it?
Up to 10.1%. So really,
I know.
300 pounds is only 270 now.
That's what I'm saying, man. Just like your buying power decreases, your strength is decreasing without you actually.
That's definitely
getting
strength.
weaker.
Yeah, I was gonna say you're lifting more weight than ever, but you're no
You're
stronger.
not stronger. Exactly.
Oh, that's so bad.
Dude, we're gonna be here all week.
Oh man, between that, if you thought that was a bad pun, and this next thing isn't a pun, it's just a really bad joke.
Oh god.
You know Adam Newman?
Oh yeah.
The guy who did WeWork and then
the
WeLive.
Yeah.
You know, he was like, "Oh, I'm a tech company. We're doing this whole new thing." And I was like, "Dude, you're a real estate company. Calm the fuck down."
Adam is the best pitch man ever. I don't care what
He
anybody
clearly
says.
is.
Give that man a Cy Young because he's the best pitcher ever. Did you know that over $5 trillion exchanges hands on a daily basis? That's an average of over $220 billion an hour. Now, how does this much money move every single day, and why does it move the way it does? Here on Drunkenomics, two bartenders who also happen to be students at the University of Nebraska Graduate School of Business are going to sit down and drink to the global economy and try and translate it into English. So sit back, relax, pour yourself a stiff one, and have a drink with us to the comedy that is the global economy. Okay, everybody, guess what? Welcome back to Drunkenomics. This is the drinking podcast with an economics problem. I don't know how many time this year.
Certainly.
I'm welcoming us all back as the less gracious host because, last week I lost the bet that I thought SPY was going to close below 400 last week. I was way off on that. It closed above 4. It closed at like 430 last week or something like that. So because of that, and because the VIX is above 20 still, I am welcoming us all back as the less gracious host. My name is Aaron.
Above 18. Am I crazy?
18,
I'm seeing it at 1961.
At one point it was
we're getting
today, but now, based on my real-time quotes that I'm yielding from Thinkorswim. Yeah, so the real-time
that's summary.
is at 2010 now. So two reasons why you're more gracious. And your name is what?
I remain James Goldwater, more gracious host and
still the same
VIX champion.
Yeah, I know. So that volatility index, I mean, if you look at the chart of the volatility index, it's been slowly declining since it peaked at 35.
Yeah.
It's
lately.
It kind of went down to below 19 for a little bit, or not below 19, but below 20. It was kind of weird. When it was below 20, I was like, what is happening?
Yeah, so obviously it was I when I just looked at it.
But I think right now, I mean, this is a pivotal point in the markets. I don't know what's going to happen, but I think it's pivotal because the SPX, and this is what everybody keeps talking about, is just underneath the 200-day moving average. So it's gone up and it's touched it, and since it's touched it, it's kind of gotten back down. I don't know if the fact that it touched it is huge resistance
yet?
Yeah, I don't know if it's super significant. Remember when the death cross was a thing, when that 50-day crossed below the 200-day, everybody was panicking. Super technical. If you're one of those, if you're like a market technician guy, death cross kind of spooked everybody out. Right now, it's right at the 200-day moving average, just underneath it. The 200-day moving average is currently downsloping. I don't know if that makes you think if it crosses above it, that's just a buy signal, or if it touches it, it's a sell signal. I don't know what your trading habits are, but yeah, I think it's a pivotal point. Everybody's talking about it. So, my hypothesis is something's going to happen. It's either going to touch it and break through, or touch it and get slapped back down. I'm not here to tell you to put on some option straddles. I'm just saying, I think it's a pivotal point. It's not financial advice.
I think this is a bear market bounce. I don't think this is real. I think this is I think this is reaction. Personally, I think this is reaction to some good news, but it's like really good news and
it's not the news is mediocre. It's not good. It's not bad.
Yeah, it's not good. It's just not awful. So so for those of you I know we've talked about how the inflation number is 8.5 when they were guessing it was going to be 9.1.
Yeah.
What that means is inflation is 8.5% year over year when they thought it would be 9.1%. It's still very high. It's still a problem.
But even then, the markets didn't really react to that.
Bad.
Yeah, but the markets just still didn't react to that.
Correct. But it's not necessarily markets that are having the issues with this inflation. It's people.
Yeah, I mean, if you look at the chart, I mean, back in, I think, what was it, April, when the SPX hit that 200-day moving average, it got killed. I mean, the markets just tanked immediately right after that. Now we're right back to that level, the 200-day moving average level, which obviously the 200-day moving average has changed since April. but we're right there, and if we break through it, I don't know, it could be a buy signal. It could be.
It could be. So what I'll say
be an overbought, like an extremely overbought signal.
I think it'll be an overbought signal, and that's.
I'm leaning more towards that too. But
there's a few reasons. There's a few factors that are coming into play for me there. And it's very much that, one, we had the Fed minutes come out today, and the Fed minutes said they're going to continue to raise rates. Yep. Until inflation is significantly under control. I think was the phrase used, and that to me says
was that.
No, I actually want to get the wording right too. So it's.
I thought it was like something about data dependent or something like that, or which I think is pretty ironic. It's like saying humans are food dependent.
Mm-hmm. It will likely be appropriate to maintain the level for some time to ensure that inflation is firmly on a path back to 2%.
That's right? So okay. Yes,
they will continue to raise rates until inflation has substantially eased.
Yeah, and 2% is essentially like the that's a sustainable. That means the economy is growing, but not too fast.
Yeah, it's a rate that they're happy.
The machine is well oiled, but not too oiled.
Yeah, the machine's not about to fly off the hinge. Things aren't about to fly off the hinge. Yeah. So you see that, and then we also know that as we talked about, as September gets here, quantitative tightening doubles.
Yeah, so that's a big one too. I think, and if you look at the bond market, I mean, have you seen the yield curve inverted that much before, ever? I haven't. Like, that's crazy.
I haven't. To be fair, I have not looked at the. I haven't looked at it since this weekend, I should say.
Right. But just for a little context, I mean, the 2 year is at around.
It wasn't great when I stopped looking, and I can't imagine it's gotten any better, right? So it's gotten
a little bit better, but the 2 year is at 3.28, and the 10 year is at 2.89, which is just absurd. Why is everybody buying the 10 year? Yeah, why are people buying the 10 year? Like, crazy right now. It just, to me, buying bonds don't make any sense.
We understand.
I've never been in love with bonds to begin with, but like right now, like why is there a rush to buy these bonds? I mean, today's
well, we know that with bonds is that people are, when you're trying to secure a portfolio against a downside, you go into bonds to stabilize and offset a lot of your risk from stock. That's just portfolio management.
Yeah, I know.
At the same time, I mean, this seems to indicate
the risk-free, quote unquote, investment. But yeah,
and what these guys are saying is essentially, it looks like they're suggesting that the near future, they're not so sure about payout or value, but over 10 years, they think that risk, that they can carry the risk through the near term, and and they could sell their 10-year bond maybe in 5 years, maybe in 3 years, maybe in 8 years.
Well, I mean, we talked about QT.
It'll have
when QT doubles in September, which is in like 3 weeks. All right, the Fed now decides that they're gonna. Well, they have to because they're gonna dump their bonds onto the markets
and take cash out.
Does that steepen the yield curve or what, man? I don't know. I have no idea.
So what I'll say is I doubt it hits the actual market in a way that you'd expect that, because these are all agreement. These yield curve. The quantitative easing, quantitative tightening, those are done through repo programs and reverse repo programs, right? So it's they know who's
really
paying them.
Because I think repo programs are overnight.
Well,
they're holding on to these on their balance sheet for.
I guess we could say, we could look at it this way: if it's treasury bonds, there's always going to be a buyer.
Right.
If it's the private bonds that look at mortgage-backed securities and other things, that's where you'll start to see interesting behaviors. They're also pretty much, I have to imagine, they're going to turn to major institutional investors and they're going to tell them, you're going to buy this back from us. We bought from you. You understood that when we gave you the cash for this asset, that we would be selling it back to you at a later date.
My assumption.
That date is now here. So it may not be.
But the bonds are cheaper now.
A repo.
So they win. But it depends when the QT actually starts, actually.
And it depends on that day, and then
will the bonds become cheaper?
And it also depends. It would also depend, I'd have to imagine, on the contract.
True.
At the purchase. Will you buy back at market rate, or will you buy back or are we going to take out the exact same amount of cash that we put in?
That's a really good question. I think, to be honest with you, I think for the mortgage-backed securities, it's probably going to be like that. But with the government bonds, I doubt it. Mm-hmm. I mean, they're technically risk, if you hold it till maturity, they're quote-unquote risk-free. You're going to get your return. But does it beat inflation? Does it beat interest? Does it beat all, that's all up in the air.
And the answer is there's like one or two that will, and those are the inflation.
The tips.
Yeah. Tips
inflation protected securities. Yeah.
Yes. But other than that, no, they're probably not. I could say with certainty they will almost certainly not beat. I can say with certainty they will not beat inflation given the current inflationary environment.
I don't. Yeah. Well, I don't know how tips are even kept up right now. I mean,
I'll be honest, I don't either.
Maybe they're trading at a huge premium. I don't know. I don't.
Well, if they're keeping up, then probably a premium because.
Yeah. Well, like I said, I've never been in love with bonds to begin with. So, that's why I said, like, why would anyone buy a bond right now? I don't know. But there are reasons, obviously they're quote unquote, ask any portfolio manager. When I talked to one of my CFA friends not too long ago, they still say, yeah, when we do portfolio management, 10-year yield is the risk-free
the gold
rate.
standard.
Yeah. So it's still like the entire world is still discounted to that. The 10-year yield.
It's not so it's not so distant as the 30-year, which is just kind of you never know what's going to happen with that one. It's always out there, and it's not so short and sensitive to the immediate economic trends like anything from 6 months from 3 months to 5 years. It's very much it's that insulated. It's not too far. It's not too close. It's a good happy medium.
But I don't know what kind of securities that the Fed is holding. Like, so, are they holding more 2 years than 10 years? So if they dump all these 2 years onto the market, that's going to crush that front end of the yield curve. It's going to push that way down. Right. And then boom, now we have a steeper yield curve. Yeah. So maybe it does, but I don't know.
Well, on the other hand, they're really going to be running into a point where a lot of these bonds that if they had all these bonds on shorter life, that have shorter lives will have matured anyway between when they picked them up and now.
So that's another good point too. So supply, but it depends. But it also depends on the issuances too. So if there's an auction that happens, or I don't know, if there's like a 2-year or 3-year auction, let's just see how those auctions perform and then go. From there.
We'd have to see.
If you keep getting D plus grades, then it's going to keep rising.
Well, and if you want to look, I'll call this a D plus just because it shows improvement. It shows improvement, but it's still a failing grade. Yeah. But
D plus, also D plus, I think is the housing market. We got a good question here in the Discord. Speaking of which, if you want to join our Discord, it's free to all. You can find our Discord link on all of our social media pages at Drunkenomical, DRUNKENOMICAL. That's us on Instagram, Facebook, Twitter, Meta, whatever. And then there's a link in the description. Love the conversations, love the questions. But we got one from John Dobos. John, I think it's a guy that interacts with us a lot on Twitter, which I appreciate.
Absolutely.
Yeah.
But yeah, it's a fantastic. I guess a graph of the down payment as a percentage of housing.
Yeah. Well, it's down payment demand, right? Home buyer down payments in 2021 were lower than 2026 during the subprime bubble, part of a long 50-year decline in mortgage lending standards in America. Foreclosure wave 2.0 is coming. He sent us a tweet that was tweeted by somebody else.
Shared someone else's tweet and then has down payments in the 90s and early 2000s was close to 20%. Down payments now are down to 17, whereas like in the 50s it was 30 to 40%.
Yeah, well, I think the ultimate question really comes down to is there going to be a real estate crash?
And this is one that I look at. It's so to answer the initial question of like an opinion on like this whole idea. Do I think there's going to be a real estate crash? Yeah, if not crash, it's going to be a major plateau and a dip because what's going to happen is you can't. Yeah. Housing is so expensive.
Yeah.
It is $500,000 and the vast majority of people in this country can't afford that.
Yeah. So I guess the reason your thesis is basically it's just not sustainable because the bottom line cash isn't there.
Absolutely.
Debt levels are already super high. Like everybody, like debt levels in America are record highs, credit card debt, everything, right? Super high.
Yeah.
So you're saying there's no money.
I'm saying you're gonna have buyers who aren't willing to buy at certain prices, and you're gonna have sellers that aren't willing to sell at the price that the market's gonna demand. Because you're gonna end up with buyers sitting here going. Because I have to imagine there's already people who bought their houses in the last 18 months, and they're gonna say, "I spent $540,000 on this house. Now I got a great interest rate, so I could afford this house. I could afford that loan. I'm not in a position where I can't afford this property. But when they turn around to sell it and they go, well, I want to make $580,000 and they try to go to market, the market isn't going to be there. It's going to be like, no, your house isn't worth that. Your house is worth 450 is what I can get. So that's what I'll offer. You're not going to accept that. And so that's when you start to see like the bid-ask spread. The liquidity, will not be there.
Yeah. I was going to get into that, yeah.
For the last 2 years, the bid-ask spread has been basically zero. In fact, the bid has exceeded the ask, weirdly enough, for most of 2020.
So we have a cross-market.
That's bad business, folks.
We have a cross-market. That's just what happens when demand is shooting up like that. But, I mean, I have a couple of things that I think... I'm gonna word vomit a bunch of things that I think are gonna happen, and then kind of piece together whether or not I think the housing market is gonna crash based off of my word vomit. So basically, first and foremost, to rent an apartment is so insanely expensive right now that I think people, like if you're a young married couple, why would you rent a 2-bedroom apartment for $2,100 when you could buy a house, take out a mortgage for $1,700 and actually build some equity?
The problem,
if you can afford the down payment.
If you can afford the down payment, one, and two, if you can find a body willing to loan you the money, and that's the next question: is are they willing to make that loan?
Yeah, but but remember in The Big Short, like it's a mortgage. Who doesn't pay their mortgage?
Well, unfortunately, in 2008, we've learned.
Slippery slope.
I'll say this in theory, they've learned their lesson. But the answer is,
if you can afford $2,100 a month, you can afford a $1,700 mortgage or $1,500 mortgage.
But banks have historically never seen it that way.
I know.
That's the thing.
I know, but what I'm saying is I just don't, like, once the loan gets approved, I think the default side might not, all I'm trying to say is, like, apartments are so expensive. It's driving people from apartments to, looking to buy a house.
Oh,
the other thing, too, is home builder sentiment is declining and pretty rapidly. And one last thing that I saw was there was a survey done, and it was like, I forget what the survey was or whatever it is, but it's basically saying that 75% of people are planning on buying a house if they see a real estate or a housing market crash. So I think those things could support the real estate market. I don't necessarily think all three of them combined have the strength to do it. I think there is going to be some sort of retracement, but I don't necessarily think it's going to crash in the manner that it did in 2008.
I don't think it'll be a 2008. I think it'll be a large correction.
But I really don't think it's going to go back down to even to pre-COVID levels. I really don't.
Oh, I'm sorry. When I say large correction, I mean over a long period of time. And I think more than that, what you're going to have to see specifically in the U.S. is a change in the type of home being built.
Well, that's already. It's already been happening. I mean, it's already like townhouses
but it's
and duplexes are popping up everywhere.
Yes, now. And that's going to be, but that's the push because this whole 1950s suburbia building, that doesn't work. Like you see it in places where they're like, oh, we're going to build these big properties with big garages and 4 bedrooms. And it's like,
and a nice yard, but who can afford that now?
So everyone's building these nice these nice $500,000, $600,000, $700,000 houses, but no one's building the $200,000 to $300,000 house that people can actually afford.
Yeah, but that's
while they're building the equity. So it's they're creating too big a gap in home ownership, and so it's for that young couple. So it's like that young couple sitting here like we want to buy a house, we want to build equity, but we can't because we can't afford the houses they are building.
Yeah,
and so it's so that's what I think. So I think there's going to have to be a correction there in terms of what the housing market.
So certain part, because like the thing is, when there's a correction in the housing market or in real estate in general, it's not just like all real estate goes down. It's certain parts, or I guess certain parts, and they all do go down, but like certain parts go down more than others.
Yes.
So you're saying the high income, the super, I forget the name of that.
I think
the really nice. What do you call those nice, like the nice house sector? Like I forget, not mansions, but like I forget. There's like an actual real estate term.
There is, and I think you go from
I think they get hit the hardest. Just like whenever there's a correction in the stock market, the high PEs get hit the most.
Not value names,
growth names.
Guys get your growth names get hit. Your value guys generally stay solid.
Sorry, the reason why I said just real quick in here, the reason why I said value names get hit is because I made a joke not too long ago saying that Walmart is now not a value name, it's a growth name because they launched Walmart Plus. So I made that joke.
And it got stuck. Oh, no.
And it got stuck in my brain. That's why I said value name is going to get crushed the most, which is not true. But anyways, so back to the housing market.
That value name might be.
Let's
they're not.
See. Let's see what happens.
Their earnings were pretty solid.
Yeah, they're trading at like a 2 PE or something like that. But whatever. I mean, not really.
It's like, you're going to see the the luxury home market get hit. The luxury, like that luxury house, you're going to see that luxury home builder get hurt, and you're going to see the starter home, the smaller
like the affordable housing sector.
Yeah, the affordable housing sector is going to stay solid. Now, there's a few other reasons for that. There's a lot of tax credits and everything else that push affordable housing and that try to develop affordable housing so it's subsidized to an extent, but it's still apparently not enough that the builders necessarily want to play the game. But I think they're going to have to. They're going to have to go back to that and go like, look, maybe I do need to do 70% of my business as affordable housing, and then 30% is that luxury, as opposed to trying to make my entire business luxury housing. Because that doesn't work in the end.
And the last part of my word vomit for the whole real estate sector is interest rates are rising, right? So like I talked about the 3 levels of support, which I think are, expensive apartments. I'm already forgetting the other things. Expensive apartments.
A desire to just buy homes on top of that.
Yeah, desires to buy homes. The fact that people are waiting for a crash to buy, like 75% of the survey results were, if the housing market crashes, I'm going to buy a home.
Or try,
I forget, whatever. I mean, I don't want to go back and listen to it. I just wanted to finish this beer. But fair. So those are my reasons for support. Just kind of like, I think one of the reasons for supporting the markets could be the excise tax on stock buybacks. But I think one of the reasons for resistance for the housing market and its levels is, one, all the reasons that you mentioned, which are it's just not sustainable at those levels, and then 2, rising interest rate environment. If we get 75 basis points, which I think we will, and I'm sorry to tell you this, there's not going to be an emergency August meeting because the September meeting isn't 3 weeks.
Yeah, because the August meeting's over.
Yeah, the September meeting's not too far away. But it's going to be 75 there, and it's going to be 75. Are they meeting in October? I forget, but there's going to be 75 in November.
They'll have it. Yeah, we'll be I think it's going to be 2%.
I think at least
by the end of the year.
At the very least 2% by the end of the year. So. In that environment, I think that's going to kind of smother the housing market, the prices of houses, but at the same time, like the cost to buy a home if you're taking on a mortgage, it's still going to be about the same.
Yeah, so that's actually one of the interesting things. I looked at the 30-year mortgage rate, and or the 30-year fixed, and it actually went down. The average went down after they raised rates. Which
so that I think that's a cautionary tale too. Kind of going off of the down payments are declining. Well, 30-year mortgage is declining too.
And to be fair, the reason that is that you've got a lot of the institutions issuing these loans are looking at it going, and they're essentially saying that lowering of rate shows that they're pricing in a market crash.
Ooh.
They're seeing a down market.
I don't know about a crash, and not just real estate, but a slowdown.
Well, but I mean, they're seeing a slowdown. They're seeing they're seeing the Fed pushing the economy into recession. So they're seeing this whole. They're going. We expect over the course of that 30 years us to be able to lower our rates because we expect in the near term to see interest rates lowered by the Fed. Well, I don't know if they're right, but that's what they're guessing.
Well, I mean, I still haven't heard the recession spoken by anyone on Washington yet.
Yes.
I mean, I get it. You have your political objectives and your political agendas.
You can bring it up later.
I don't think crying recession right now would be the smartest thing to do, depending on who you are.
No,
so
it probably wouldn't help anyone.
Yeah.
It would help the Republicans because they're not in power.
Exactly.
But as a whole, I don't know that it would do any good other than political.
Well, I mean, this is the thing: is recessions suck.
Yeah.
So nobody's rooting for a recession, regardless of who's in power, because recessions suck.
Yeah. And so all we'd see is it would make political hay, but it wouldn't make any economic. It wouldn't be of any economic value to declare a recession. So that's
exactly.
We're in one, but it's again the weirdest recession.
An extremely weird recession. Absolutely.
So you're looking at these you're looking at percentage rates, and yes, percentages are very useful because it tells you whether or not people are spending the same essential buying power to buy a house. I'm willing to bet that if I went and looked, people are actually paying a greater dollar value than they were historically, because houses have gotten more expensive than ever before because houses are being treated as assets, not as durable goods.
That's just because inflation, and not to mention, this chart stems back to the 50s. You think about it this way: if a house was $60,000 in the 50s, then that same house would be how much today if it was just inflation? Right.
But
it's also the fact that you're right. It is an investment. It's an appreciating asset. As long as your economy is growing, it's going to appreciate in value. Like your real estate is going to appreciate value and maybe even outpace interest.
Okay. So the average house in 1950 cost $7,354. And that means that the average, that if it was just inflation, that same house today would cost $90,407. The average house today costs $500,000. So yeah, it's that the houses.
Wow, what is that? Like a 1,000% increase?
1,129. Yeah.
Yeah, but I think it's also like, I mean, there's been like this fad towards real estate investing in the last like 30 years.
People treat houses like assets, and so essentially, what it is, the higher the price, the more people are willing to.
But they kind of are. For it. I mean, you're living in it, whenever you decide to stop living in whatever house you're living in, if you own it or have equity in it, I mean, you're probably going to get some ROI from that equity.
Absolutely.
So
because there are more people, and because of the slowdown in housing construction, there are fewer houses for those people.
Yeah, and as long as the economy is growing, like it's going to give you some sort of return. And speaking of the economy, and like
fun week for retail.
Yeah, so like this was a jam-packed week for retail because retail earnings all came out this week. Walmart, Target, a bunch more.
Home
Depot, huge one. I think didn't Lowe's come out today too? TJ Maxx, Ross stores. Bunch of.
I know. I think Kohl's is tomorrow.
Oh, geez.
That's usually a good.
Yeah. And while we're on the Kohl's subject, the Bed Bath & Beyond. I mean, dude, short squeezes are starting to happen again with GameStop and Bed Bath. But whatever. I mean, let's talk a little bit more about that later when we start talking about our main subject. But yeah, dude, retail numbers really shocked me because the retail sales, like, it didn't really change much. Like they were flat. It was like a 0% change, to summarize it, in retail sales month over month.
It's just where they were.
Yeah. So if you honestly, if you just get rid of autos, like car sales and gas or something like that. Yeah. So cars and gasoline, if you get rid of those two factors, retail sales actually went up. Which is so weird because if you're looking at like retail sentiment is so weak. But here we have this data that's showing, okay, instead of energy and cars, which,
cars are.
But car sales could be down just because cars are just tough to buy. Like if you buy a car.
They're hard to find, hard to buy.
Yeah.
And then.
Well, and if you buy
of course, car sales will be down.
Yeah. So if you buy, like, honestly, right now, if you buy a new car, like, you're not really buying a new car. You're buying to wait 3 weeks to own a car. That's what you're doing.
Yeah.
So
it's like, very much wait on delivery.
Yeah, wait on allocation.
Yeah. Looking at like the major retailers. I know Home Depot was up, and based on things that Home Depot was saying about their retail, what they were saying is that their sales were up, and that increases in prices on their products had not yet led to consumers buying lower quality products. So it seems to suggest that in Home Depot, the inflationary pinch isn't being felt yet, or isn't slowing anyone down.
Oh, geez. Walmart's chart, man. If you look at Walmart's chart, if you look at their daily chart, which is the 1 year, 1 day chart, man, that's a really interesting chart. I mean, there's a gap down back in May, and then now there's a gap up that almost filled the previous gap down, which is, I don't know, that's pretty interesting.
Well, so Walmart, and I happened to, I was looking at I was reading some of the stuff about their retail numbers. What Walmart was kind of indicating is that, so they've done Walmart, what is it, Walmart Plus? They're like, they have their online services. But no, is that Walmart's seen that its largest cohort, the cohort it's seeing the largest increase in purchases from are people who earn $100,000 or more a year. And
exactly.
That now they've said some other things that were a little less good. So like they said, our big increases in sales were in back to school supplies. Okay, great. Well, that's not going to happen for the other 3 quarters of the year.
Yeah.
And then the other ones they said was food or groceries. And I was like, well, okay, because people need to eat. So yeah, you drove it in two places where you're seeing pretty high inflationary.
Yeah, but the thing is, they're saying like, okay, so as far as the grocery side goes, like when there's people that are making more than $100,000 a year that are shopping at Walmart more often now, I think they're also going there and going like, well, while I'm here, like, oh, I forgot I need to get, some cucumbers and whatever, so they're buying groceries.
Absolutely. So, to be fair, I think it might actually go the other way. I think it might be people are going, food prices have gone up a lot.
And that's what so that's the other thing I was going to say too.
I'm going to get groceries, and then it's while I'm here, I also need blank, or, I need toilet paper, or I need shoe polish or whatever it is. And they're already there, so it's convenient.
But basically, like what Walmart basically is saying is, okay, their revenues from groceries have gone up, dramatically, and their marginal revenue because of that, as a result, has gone up dramatically as well. So I think investors kind of looked at that and they're like, okay, this is a very bullish thing for Walmart. So
it is.
Let's gap up.
So then, the next part is, okay, well, let's see what happens. Let's look at what happens at Target, or what happened at Target today when they announced.
Yeah, and Target got crushed. But they've
Target
also
got crushed.
Yeah.
And now, Target was marking down its inventory just to get it out of the stores.
Yeah,
but they warned you. Target had warned ahead of time.
Yeah, they did that back in May. So they got crushed in May. I mean, everybody got crushed in May. Remember? Like, all retail got crushed in May. Everything. Walmart got...
Target's still going. Now, I know Walmart inventories were up something like 26%. I know at the same time, Walmart's argument for why that is that for the better part of the last 2 years, they have struggled to maintain their inventories, and so that 26% increase they currently have is them still just trying to catch up with with their historical problems.
So like
with that. But
like, remember when I was saying like Walmart gapped down in May, Target gapped down the same exact day. They opened dramatically lower, like 20% or whatever lower. And I forget what the catalyst was back then, but I'm pretty sure it started with Target's earnings. Target's earnings got crushed, and as a result, because like for some reason, I don't know why, but it's the same with financials, it's the same with energy, it's the same with everything, right? Whenever there's a reason to sell energy, whenever there's a reason to sell, like whenever there's a reason to sell JP Morgan, there's a reason to sell Bank of America and Wells Fargo and Goldman Sachs.
Yeah. If it's affecting one, it's affecting all.
Yeah, I don't get it. But like same with
industry.
Same with like if Nvidia says something negative about their own company and their own operations, Nvidia, Micron, Intel, all those companies get crushed too.
AMD.
AMD.
Well, yeah, but whatever. It's because one has to conclude that if Nvidia says
they're having this problem, odds are AMD
everyone
is
else probably is too.
Yeah.
If Howard Semiconductor said, "Hey, we're having trouble sourcing sand," Intel probably is too.
Yeah, exactly.
No, exactly right. That's exactly right.
Yeah.
This time around, I think though the difference is that Walmart has historically been a lower cost operator, whereas. Or a lower price operator, and Target's been a higher price operator, and so I think that's what we're seeing now. Is that that those people making that $100,000 more have left Target, they've gone to Walmart, and that's become a thing.
And that's exactly what the retail reporters on CNBC were saying too. It's like Target it appeals to more of the higher income, the higher price operators, which like those $100,000 household income a year people. They used to be shopping at Target, but thanks to inflation, they're shopping at Walmart.
They're pushing.
So that's kind of what it is, Like, I mean, you go to Target, like your shopping experience, I'm assuming is much better than your shopping experience at Walmart. I'm assuming, but you're paying for it.
Yeah, so, you're paying for it. Sometimes you pay for what you get.
Yeah, exactly. With that said, we need to move on into the next subject.
We did have that one more question that we wanted to touch on, just because it's we got two questions about it. I guess it's not just the one question; it's two that are vaguely on the same topic, but one is kind of our opinion on.
Oh, sorry, dude. The bell just rang and it went off in my headphones, and that was really loud. The closing bell, so the market's just closed.
Ooh.
Yeah. And speaking of the markets, what is the market made up of? A bunch of stocks. And speaking of stocks, awful transition. It's a long, awful transition.
But you know what? Stocks come in several forms.
They definitely do.
So do companies. So we got two questions kind of about how, because we'd said last week, I think that we were both kind of on the same page, that we think the excise tax on stock buybacks is probably a good idea.
Yeah.
It puts the brakes on,
I mean, I don't want to say
corporate money.
I don't want to say it's a good idea. I don't want to say it's a bad idea either. I'm very neutral on this, on the excise tax.
I think it's probably a good idea. At the very least, it puts the brakes on.
I think it's better than a bad idea, and I don't think it's that much less than a good idea. I'll say that much.
Okay.
I'm more in favor of it. It's like 51-49 in favor of it in my own head.
But we got a question which was essentially, what do we think about stock buyback rules having different scenarios for privately held companies versus publicly held companies? And Bob here concedes that there's no question that buying back stock increases the value for stockholders. But privately held companies are not the same as public. And he sees a problem with one size fits all. Well, the great thing is about the way that excise tax is written is that it isn't one size fits all. Specifically, it's not. It's very much, it's for billion-dollar companies plus.
Oh, is it really?
So it doesn't, that tax does not affect any company that earns less than $1 billion.
What do you mean by earns?
I'll assume it's revenue.
Okay.
I'll assume revenue.
Okay.
Because you can't put an excise tax on a buyback on profit that happens after the buy, right? Because I can just buy back enough to drive myself under $1 billion. So I have to assume it's revenue.
Yeah, but I feel like $1 billion in revenue is not that much. I mean, I feel like, if you're like an MLB or NFL franchise, your revenue is, I think your revenue is $1 billion. I don't know. I don't know what.
The Dallas Cowboys had revenue in 2020 of $800 million.
Okay. Oh, sorry. They're valued at like $10 billion. So, okay, my bad. Yeah. So I guess their revenue. Wow. Okay. So they're not under the same.
Right. So this give you an idea of how the biggest NFL team does not meet the mark. Yeah. And then the Dodgers only make $565 million.
The Dodgers make that? What were the Yankees?
Okay, so the Yankees in 2021, $683 million in revenue.
And they are the highest earners, I think, in the MLB. And there's no way anybody.
No, it'll almost certainly be Yankees number 1, Dodgers 2, Red Sox probably
Red Sox 3.
Maybe Red Sox.
Yeah.
Maybe
the Cubs.
Yeah, maybe, but still, if they're flirting with 700, 600, 500,
they all ballpark got to be near there if they're the Yankees. The Yankees are by far
exactly the Yankees would have the most.
Like you'll see like New York Yankees hats in like India, like
absolutely.
You know what I mean, like
which is why I looked at the Dodgers for personal reasons. I wanted to look at the Yankees just to see if there was that much of a difference. About $100 million. Wow. But that's the revenue. So think about it this way. So like I don't think any major league sport is affected by this in terms of revenue. Now, they're all privately held as well, except for Green Bay. So
the Green Bay Packers,
So it doesn't affect any of them. Not even the Green Bay Packers are affected by this excise tax. So it only affects companies that earn $1 billion in revenue or more, and it's only 1% on stock buybacks that they do. Now, the question is, do we think it's, I guess, different rules for publicly versus privately held companies? I guess my response to that is we already have different rules for publicly versus privately held companies. There always have been, and there always will be. I don't necessarily see it as a problem.
Yeah.
The big one is that in some states...
Well, because why would you tax... you own a bar, basically, why would you tax someone if they're going to try to buy back portions of their own bar? You know what I mean? Like, it just doesn't make... why would you put an excise tax on that? It doesn't make any sense.
Yeah. Well, the thing is, with a lot of, smaller, especially privately held firms, these smaller firms that... It doesn't necessarily make sense for the bar to be for a company to buy things versus the individuals owning it to buy things, because usually at that point you're dealing with such a small
the market is tiny.
Privately held, you're dealing with such a small number of owners that it's very clear.
Yeah, and the market is tiny. I mean, the liquidity isn't there, so it's not like, okay, if you want to sell your shares of Apple, you can just dump it on the market. Yeah, you'll find a buyer like that.
That's the first thing. So in private companies, there's no active market. Yeah. That's one. There's no active market. It's just someone may be willing to buy it for a price, or you can sell it back to the other people that own it, so they don't have to keep paying you out a dividend or whatever.
Right.
But the big thing is with a lot of privately held companies is that there's almost always a single majority shareholder or just a block of major shareholders. So it becomes impossible to make a legal distinction between the company and the individuals owning the company.
Yeah.
With publicly traded companies, that distinction doesn't really exist. Like even if you hear so Elon Musk is the single greatest shareholder in Tesla.
Yeah. And a few other companies,
Tesla's publicly traded.
Tesla.
But Tesla is publicly traded. But he only owns 17% of Tesla. So he owns more than anyone else, but less than everyone else.
Yeah.
So while he can bully the management team to kind of doing what he wants, if the rest of the owners are opposed to his actions, they can vote that. A private company, if you have one guy who owns 51% of it and another guy who owns 49, the guy with 49%, if the guy with 50% goes, or 51% says, I'm going to use company money to buy your shares from you. Well, really thinking about it, 49% of the cash, assets in that firm,
the assets and the cash,
him. You can't buy my shares from
of the assets, including cash,
with my own, with using my own assets. That's like stealing my wallet and
it'd be like stealing your credit card to buy your car from you or something like that, or I don't know.
Yeah, it'd be like stealing my wallet it'd be like stealing my cash out of my wallet to buy my sunglasses from me. It's at no point have I actually seen financial gain on the deal.
I mean, you do get some financial gain because, but basically every dollar that's being spent, you're really earning, you're really getting 51 cents.
Yeah. So I suppose what I mean is if you agree that okay, the company that the firm has $300,000 in cash or cash and cash equivalents in it, and I agree that I'll sell you for $100,000 cash now, and then you pay out blank amount of cash for a period of time until I'm made whole on what I consider to be my take of the company. That's fine. That's okay because there's an agreement. But such a non-market. It doesn't really make sense. Whereas some publicly traded companies, it's different. Whereas you have huge. When you have hugely active markets. So when you see a company that can make plays like that and actually just start saying, well, I can use corporate, where what you'll really see is, and it's a different aspect of self-interest, where you have a manager of a company who might say, I'm going to miss EPS by not much, but it'll be enough to cost me a $7 million bonus. I'll just buy back some shares.
Yeah, but the thing is,
I'll make my EPS.
But the thing is with private companies is obviously when you buy a private company, you're also buying into the future earnings. Just like when you buy stock, you're technically quote unquote buying portions of the future earnings. So when you buy a private company, it's like the investor goes, I think the guidance is going to be this, and that's why I'm paying this. Right. Whereas like in a publicly traded company, it's like the broader market thinks the guidance is going to be like this, and that's why it trades the way it does, or that's why the company is valued at
and you
$1 trillion or whatever it is.
And you also generally with a private company, when someone says the company has this value, that's pretty close to the balance sheet value.
Yeah, like I mean, it depends, right?
There'll be some for future growth. But what they'll say is like, the company's
like Mark Andreessen buying Adam Newman's company. Obviously, that is not. James, somebody call 911. James is dead.
How does that guy get a sec? All he's done is resurrect WeLive and change the name to Flow, and despite not making that one work, lying about it on multiple financial programs, and essentially committing pretty substantial amounts of fraud. He still has $1 billion company that hasn't done anything.
Okay, but this is the thing. So Mark Andreessen, love him or hate him, I don't care what you feel about Mark Andreessen, but I think he's an idiot in this transaction. But he has made some brilliant decisions, and obviously he's a multi-billionaire. Or I don't know if he's a multi-billionaire, but he's at least a single billionaire.
Yeah, he's doing fine.
Yeah, he's doing just fine. But it's his firm, Andreessen Horowitz. They're the ones that bought into his company.
$350 million.
I think we can both agree that it is not the book value of the company. It is very much pricing in the future cash flows and the guidance at a massive premium. So sometimes you'll get, that's the thing about private companies. Sometimes you'll get deals like that where, this company is in its startup phase, kind of like, Walgreens Boots Alliance buying into Theranos.
This
is bad. I'm giving you all these bad, terrible analogies, but I guess maybe it's like P&T will get into Facebook.
Do you know what I think it is? Yeah. I think it's like everyone that invested in WeWork 5 years ago.
Right.
Like, is there legitimately an issue with affordable housing in Fort Lauderdale, Atlanta, Nashville?
Right, but
there is.
But the thing is, like, okay, but
I'm not sure that this guy is the solution.
I'm with you on that.
And I don't know this company.
No, I'm with you on that.
I don't know that his company. You have thousands of units. I don't know how you get to $1 billion quite so quickly.
Yeah. 100% with you on that. Like, I don't understand why people think that Adam Newman is an investable entity, but
I hope they did
at the same time, like, yeah. But like, when the angel investor got into Uber, obviously their ROI was massive and then some. But Uber wasn't trading one to book.
No.
But like the thing is, back to the actual subject, like the majority of these privately held companies, and let's be honest, the majority of companies in the U.S. are small businesses, bars, restaurants, law firms, dental practices, things like that. Yeah. So it basically would be like a junior partner of a firm that wants to sell.
It wants to sell their
part of the law practice to the senior partners to start his own law practice, and why would it make sense for him to be bought out with company money when he technically owns part of the company? Yeah. So I get with you on that, but like on publicly traded companies, and this kind of ties right into Panson's question, which is how do stock buybacks increase the value of stock? And then from there, do the shares just transferred to the hands of the company? Do they get deleted, quote unquote, when they get bought back? If it's the latter, then when a company issues shares to employees as compensation, are those shares actually created when they vest? Yeah, those are
there's a few
all those questions kind of tying together. The first one really, like how do stocks get priced? It's supply and demand, like anything else, right?
Yeah, if there's someone willing to buy it at a price, I'm willing to sell it at, that's where it is. That's why you see the fluctuating ticker.
Yeah, it's like oil. It's like oil, right? When there's 400,000 barrels of oil, and and there's 500,000 willing buyers, they all kind of have to pay a bit of a premium. Just like if there are 1 million outstanding shares, but there are 2 million investors that are trying to buy at least one share, they're going to have to outbid each other. And that's going to drive up the price of the stock. Stock buybacks is basically like, there are 1 million outstanding shares, and then there is a single entity saying, I want to buy 200,000 shares back. What does that do to the demand curve for that stock? It pushes it to the right, thus pushing the price up. Increased demand, increased price.
And more importantly, you also have that decreased supply.
And you have and you have
the there's fewer shares sitting in the market.
Yeah, I mean, because it is a buyback, the decreased supply, because the company's buying back their own stock. But I mean, just basically, like if Warren Buffett wanted to buy a bunch of shares of a certain company, it's going to shoot the stock price up because it's same supply, increased demand. But in this case, it's increased demand because it's the same company buying back its own stock, which is also going to decrease the supply. So obviously,
and we also assume when a company buys back its own stock, when a company is buying treasury shares or treasury stock, that it's or creating treasury stock by buying shares off the market.
You can't. They don't buy treasury stock.
They create it by buying stock.
That's how they
by
do
buying
it.
shares of themselves off the market. It then becomes what's called treasury stock in the assets.
Or if they issue shares and then they just buy shares that they immediately issue, which they can do. But I mean,
it's the assumption. But the assumption is that they have a strategic plan for doing so that they are leaving the market. So a company can, when a company is created, there's a few things that happen in its articles of either organization or its articles of incorporation. And those things are that it authorizes a certain number of shares. That's the first thing. They'll say, hey, during the life of this company, because think of these documents as essentially a constitution for the company, the rules it has to follow, and then certain things. So what they'll say is, we'll authorize blank many shares. So at no point may there be more shares than that in existence. And so that's the first thing they do. And the second thing they do is they might say, like,
can they change those articles, though?
Issue. They can.
Okay. And
they can amend them.
Okay, so the second thing is they tend to issue.
And then they intend to issue. So say that you start a company and say, hey, I'm going to authorize 5 million shares. Tomorrow I'm going to issue 100. There's only 100 shares that exist.
Authorization
created.
And issuance. Yes. Okay. Yeah. I remember.
So
you're taking me back to my Series 7. Yeah.
I can issue up to 5 million, but right now, because I can issue as many as I've authorized, but right now I've only issued 100. Mm-hmm. So there's 100 out in the market. I issued them and I sold them at $100 each, and now they're trading at 50 on the market. Well, I already have the cash from that first issuance, because I sold them at the IPO, and now they're just crashed. Well, you might decide I'm going to buy back half the shares, drive the price up, and be back at my IPO level. But now I hold 50 shares in treasury stock. So to the rest of the world, there's only 50 shares to compete over in the markets, and I'm sitting on mine. I record those, I hold on to them, and so now I've got an employee, and he has a stock option that he can buy shares for, I don't know, $60.
Yeah.
I might take one of the treasury shares I have and give that to him. Say, here's your share. Give me my $60. Yeah. And then when I sell him the share, there's a delicate amount of bookkeeping that occurs. And so what happens initially is I'm gonna debit the $60 he pays me, because I now have that cash. I'm going to credit treasury stock by $50 because that's what I paid to buy the treasury stock. Yeah. That specific share, I paid that amount of money to buy it. So I have to credit that out of the value of my treasury stock. And then I've got a plug, and I would call that gain on sale of treasury stock. Mm-hmm. Now at the same time, that same guy, maybe his stock option was $10 a share. Well, I don't want to take a $40 loss on sale of treasury stock, so I'll hold my treasury stock, and then maybe I'll just issue a new share and give it to him.
Well, and this is the thing too. Like, I think this is a big thing that people need to understand about treasury stock is whenever a company buys back shares and it becomes treasury stock, it is no longer considered under the umbrella of shares outstanding. So if there are 1.3 million shares outstanding, company says stock buyback program, 300 shares. Now it's 1 million shares outstanding. So that's a big thing. Yeah. Right. So obviously,
so that big one is you change the denominator for calculating EPS, because earnings per share is earnings divided by shares outstanding. It's not the shares issued. It's all the shares that currently aren't in possession of the company, because how much earnings does a share earn or have the right to claim in? And the company doesn't have a right to claim in.
Yeah, and even market cap too. So if it's a $1 trillion company and there are 1 million shares outstanding, then obviously it's trading at what, $100,000 a share. So that's an awful example. But but yeah. So if that's the case, right? and there's a buyback program of whatever it is, then all of a sudden it's $1 trillion company. Let's just say it's $500,000 buyback or 500,000 share buyback program. That's $1 trillion market cap based off of 500,000 shares. Market cap's still the same,
and my shares have increased in value substantially because I've reduced the supply of I've reduced the shares outstanding. So the question there of do they get deleted when bought back? Yes and no.
Yeah,
no, they don't. They can be. So they can be. A company can buy back shares. How does the deletion process work? And then it can.
How does it go from treasury to like non-authorized? Not that it's that important, but
so it's called retirement. So you can retire shares.
That's what it is.
So I could buy back shares and retire them, which means that they go from being issued back into the ether.
That's the deletion that he was talking about. That Pan.
That's the deletion. Right? So can do they get deleted when they get bought back? No, specifically no. They don't always. Usually they do not. But I could buy back shares to retire them. So like, usually what happens is if I'm really strapped for cash, so I issue a huge number of shares, I get the cash, it gets me through the hard time. Business is good again. I start buying back shares as the company, and then I start retiring the shares as I buy them back because I don't want to hold them as treasury. Yeah. I don't want to buy them myself.
Yeah. If you look at a company like Bed Bath & Beyond that has gone through the short squeeze, right now would be a perfect time if they have any treasury stock to sell it because they're going through this massive spike in volume. The stock is
and spike
shooting
in price.
Up.
So
and spike in price. So if they needed money, if they needed cash, right? I mean, like we talked about this last year when GameStop and AMC.
Because GameStop did do it.
Yeah, they did do it.
Did begin to sell treasury into it.
That was the best thing that could ever happen to GameStop as a company, aside from them just being good at selling things. But on top of that, they were in a pinch. And this was a saving grace for them. They were a failing company that we talked about it. We were on a different podcast talking about whether or not GameStop was going to make it through the end of the year of 2020.
And I thought
I thought
no. And I'll be honest, without
the short squeeze, without the short squeeze, they probably would be
have.
They were able to raise so much money off that short squeeze, and same with AMC, and that's same with Bed Bath & Beyond, right? So if they didn't have any stocks in their treasury inventory to issue, or not issue, because in that case they wouldn't be issuing it, but
just sell out.
Yeah. Then in that case, they could just
amend some things and
then issue some shares, right? I mean,
if they did, there'd be dilution and sell them into the.
There'd be some dilution
in the market too. That's also.
Yeah, exactly. But they don't get deleted, and basically, like whenever they have a bunch of treasury stock, yes, they can use that stock to basically give to employees for compensation. And a lot of companies do, like in what is it, ESPP, the stock purchase program, employee stock purchase program, or something like that. A lot of times, the stock purchase program for employees it's usually you get to buy the stock at its cheapest price in the last year and then take 15% off of that price as well or something. I forget.
It all depends on how they're written. So
yeah, exactly.
So that question.
So in that case, they can sell it to employees and raise a little bit of money that way too. But
so the question, that question, are they actually just created? Are they issued? Are they created at the vest period? They can be. So it depends if the price on the market is extremely high, and So say you got a share that like part of your vesting package is just that you have the right to buy shares at $15 a share, and they're currently trading at $900. Yeah, they're almost certainly just going to issue shares and give them to you. Go have fun and do whatever you're going to do.
Well, usually if you have shares from the ESPP, like you're not like you can't sell it right. You can't just buy it and sell it right away. Like
usually you have a lockup.
You have to hold it for like a year. Yeah, usually you have to hold it for a year. Like otherwise it's like insider trading or whatever it is. But
yeah. So the other reason is, if I'm sitting on treasury stock that maybe I bought at $7 and you can buy at $15, maybe I will sell you the treasury stock that I'm holding to raise a little bit of capital internally. Yeah, because I bought these shares at $7.
Yeah, so you raise a tiny bit
of to you.
So you get a little cash that way. Not much, but you can do that and try and seek ROI elsewhere.
Yeah. Also, I look at that and I say I have a decreased tax liability. Like I don't have to deal with quite the tax liability I would if I went to sell into the market.
Oh yeah.
The tax on $15 or on $7 to $900 is higher than the tax on $7 to $15.
Exactly.
So like 8 versus.
And it's also in
it's
also in a higher bracket too. So
that's just kind of treasury stocks in a nutshell. Buybacks in a nutshell. The reason I really don't like stock buybacks in general is that I find that
selfish.
It's selfish. I'm going to use corporate money to give myself a bonus because maybe I haven't been able to drive revenue the way I was expected to, or I haven't been able to get costs under what I was expected to because I haven't done it right. I'm going to use the corporate money to drive up earnings per share, and not by increasing earnings, but by decreasing the number of shares.
We also know that algos, the people that drive the markets, or the systems, the technology that drives the market, it's usually the algos, and they're a slave to appearances. So because of that, if you announce a buyback and it breaks through a resistance level, bam, algos dive in. Maybe they do.
If all you're looking at is EPS and no one's sitting there going, well, how'd they do it, right? So if all you looked at was target revenue, you'd go, hey, Target's revenue last year and this year was the same, exactly the same. That's perfect.
But EPS expectations, oh my gosh,
oh wow,
murdered.
Profit, down 90%. Year over year, despite the same revenue. Oh boy, that's an issue.
Yeah, but like I said, they're slaves to appearances.
And speaking of being slave to appearances, Tim, I'll be honest, that is a sweet looking. That is a good looking gym shirt.
Yeah,
we need to know how did it go at the gym, because
seriously,
that's going to turn some heads.
Yeah, I bet they were slaves to your appearances to the gym.
Absolutely.
And if you want to match Tim, this is a weird transition now, and it kind of came out of nowhere, but whatever.
Either with or without sleeves, with or without hood. Your call. Check us out at drunkenomics.myspreadshop.com.
Yeah, that's drunkenomics.myspreadshop.com. Get yourself a hoodie, get yourself a black tank top, whatever it is you need. I mean, we're going right into winter, and stay warm.
I was gonna say, right now, depending on where you are, maybe the sleeveless is the way to go. Get in shape, and then going into winter. Yeah. Get the sleeves, get the hood, and just stay warm. It could be a really rough winter given natural gas.
Yeah, exactly. Given that gas, but the famous words of Tony Montana: "Dress warm." But from there, if you already have too much merch and too many tank tops and too many hoodies, you could also support us, help us keep the liquor cabinet stacked, ice cubes cold.
The lemons yellow, the limes green, and
that could be
and the liquor smooth. Then check us out at patreon.com/drunkenomics. DRUNKENOMICS.
Nice. And then last but not least, check us out on social media. Add us on LinkedIn. Message us whenever you want. We're always happy to hear from you.
Absolutely. We'll try to answer your questions.
Yeah. But until then, my encouragement to you is to remember to always fill and kill, like I did. Not bragging, just saying.
I found a cider that might be the most me cider ever.
Now you are just bragging, and not just saying.
Just saying.
So, okay, fine. Have it your way. But yeah, with that said, thank you so much for drinking along with us. Really appreciate it. Really enjoy them all with you. I guess I don't know. I feel like I'm forgetting something. What am I forgetting? I need to say something.
Well, in the weekend ahead, I'm gonna have to go with Stay Drunkenomical.
That's what it is. Cheers, my friend.
Cheers.